Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to equipment short-term financing versus long-term financing options. And get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. Our basic scenario is going to be that we're going to be purchasing equipment. So we want to purchase equipment. We got to finance the equipment that we are going to be purchasing. We're thinking about different financing options for it. Either we have the fixed financing option where we fix the rate, or we can have some kind of short-term financing option, possibly a situation where the rate may vary in the future. There could be some uncertainty. That'll often be the trade-off when you're thinking about different types of loans. For example, do we have a loan that will have a fixed rate over the time period we're covering, in this case 3 years, or is there some kind of short-term option, typically having a lower rate at this point in time, but possibly some uncertainty as to whether that rate will go up because it will depend on the market. So we have the purchase of equipment. The life of the equipment is going to be 3 years. The cost is going to be $420,000. Financing options. We have the fixed option where we could say, hey, we're just going to be financing the entire $420,000 that we need to purchase the equipment, and it's just going to cost us 10% each year. So we're going to have a 10% interest rate. Or we can have some type of short-term financing option where they say, hey, look, the interest rate for the first year is only going to be 8%, but we don't really know possibly what the next interest rate for the next years will be. We can predict and make some projections out there and think about best case and worst case type of scenarios, right? So we could say, all right, well, assume in year one, if we can roll over that 8% for the 3 years, that would be great. You know, that would be less than the 10%. So that would be better for sure. We can do a calculation based on that and see what kind of savings we might have if the market stays steady. Or we could say, well, what happens if there's a bad outcome and the interest rate for year 2 and year 3 jump up to, say, 13 or 16? Maybe that's worst case scenario that we'll try to look at and see where we would be in that case to figure out, you know, our decision-making process between kind of like the safe option up top and the more volatile possible option that could lead to more benefit on the bottom section here. So we'll do our calculation up top. Now we're also going to assume, note that the interest is going to be paid at the end of each year. So we're going to assume the interest is paid at the end of each year. Notice that when you think about a lot of financing that you might do personally, you might have the financing option where you pay back monthly. You could still do a similar kind of analysis, but it might be a little bit more complex given the fact that when you pay monthly, you're paying back the interest and principal. The principal will be decreasing to some extent each payment you have. If we have the loan set up so that we're only paying the interest on the loan, then the principal remains the same until the end of the loan, which we will then pay back. It's a little bit more simplistic for us to then understand the loan process. We may do that in business, more often because we're basically saying, hey, look, I want to borrow the 420, the entire principal, and pay it back at one time at the end of the time period, and then pay the rent on the purchasing power of it during the time, and that's going to be the interest payments that we will then be making. So we could set up the fact that we pay the interest payments at the end of the year, or we might simply pay interest each month as it goes throughout the year, and then pay the principal back at the end. So we could have a whole variety of different loan options, and the way the loan will be set up. This option is a more simplified option, which really helps us to kind of think about different types of loan settings when we have this type of option. If we have the monthly payments, because we're paying some interest and principal back each time, the focus for that type of loan option is usually focused on, can you make the payment, versus comparing and contrasting different loan options oftentimes, because the objective is to pay back the loan and make the payment steady, as opposed to reducing the interest as low as possible. So it can actually complicate things to analyze the loan a little bit, but the trade-off is that you're focusing in on the interest payments. If you pay just the interest back and you do a loan like this, then you're kind of focusing more on comparing and contrasting the loan options rather than basically breaking down the interest payments, the payments to a fixed payment method or a payment amount. Okay, so let's think about this. We're going to say, all right, the loan, first we have the loan up top is going to be the 420. And we're going to say the rate on the loan is going to be 10%. If we do the fixed and lock it down, we're going to lock it down 10%. We're then going to make this a percent cell, go into the Home tab, Numbers group, percentifying it. We're then going to put an underline, home tab, font group, and underline. That's the rate per year. So whenever we hear interest, whether we're going to be paying it back monthly or whether it's a 3-year loan, we mean interest when we say interest, unless said otherwise, interest per year. So then we're going to have the interest per year amount. Year amount is going to be equal to the 420,000 times the 10%. So we're going to be paying 42,000 at the end of each year. That's the rent on the purchasing power of the 420,000, the rent on the use of the purchasing power, the use of the money. And then we're also going to have to pay back the original stuff that we borrowed, the 420,000 total at the end of the 3-year time period. Then we're going to have the number of years. So number of years is going to be 3. So that means that the total interest we're going to be paying, let's put an underline here, home tab, font group, and underline, is going to be the interest for life of loan. Life of loan sounds nice. It's going to be equal to the 42,000 times the 3. That's going to be the 126. So we're going to pay 42,000 each year, adding up after 3 years to 126 only on the financing, the interest of it, and have to pay back the original stuff we borrowed, the 420,000 at the end of the 3-year time period. All right, let's do option 2. Then we're going to say, let's think about a situation where we are paying back the 8% with the short-term financing. And we're going to say, well, what if the 8% was able to roll over? It's going to vary. Well, like, we don't know if it's going to roll over. It depends on the market, what's going to happen next year. But if we could pay just 8% each year, then we'd be better off. How better off would we be? Is it worth the risk of it possibly jumping up? In the meantime, let's check it out. We'll say, well, if it stays at 8%, we could do the same type of calculation. We could just say, well, the loan's going to be still that 420. The rate is going to be equal to the 8%. The 8%. I'll percentify this, home tab, numbers group, percentifying it, underline it, home tab, font group, underline it. And that's going to give us the interest per year. I'm just going to say equals interest per year, which is going to be equal to the 420 times the 8%. And then we're going to say that the number of years, once again, number of years, probably have an S here. There. Okay, and then the number of years is going to be, once again, 3 years. I could pick that one up. Let's underline that, go into the home tab, font group, and underline, multiplying this out. Now we got the 33,600 per year instead of the 42,000 times 3 years for a total of 100,800. So that's better. That would be better. But, what would happen if, like, the interest rate jumped up? We can start thinking, what would, because we don't really know what's going to happen. What if there's like a worst case scenario where we know the first year is going to be 8% because they've locked us down on that one, but it might jump up, let's say, all the way to 13, 16, just in case of worst case, and see what would happen if that happened. What would happen in that case? So that we have to break it down because it's not an even rate for the 3 years. We got to break it down 1 year at a time. So we'd say, all right, well, the interest for year 1, would be equal to the loan. I'm going to have the loan amount times the rate, and then that'll be the interest for, let's just say, year 1. So the loan amount, once again, is going to be equal to the 420,000. The rate now is going to be 8% for the beginning, and then it's going to change from year to year. Let's put an underline here, home tab, font group, underline. Then we'll multiply this out. This is going to be the 420,000 times the 8%. And then we'll indent these 3, selecting these 3, home tab, alignment, increase the indenting. I'll do that one again over here. Home tab, alignment, increase the indenting. Then we want the interest, year 2, I'm going to say this equals or plus the loan plus the rate, and that's going to give us the interest year 2, and there we have that. So the loan is still going to be at the 420,000 because we only paid back the interest, not the principal. Principal's not changing until we pay it back at the end. The interest rate we're assuming is going to jump up to 13%. And so we have that there. If it didn't get percentified, you want to go to the home tab, numbers, and percentify it. Then I'm going to underline it here. Then we'll multiply that out. That's going to be the 420 times the 13%. And notice this outer column, I don't have it, it's not giving me the same formatting. So what I'm going to do is I'm going to format paint this cell. You may not have to do this. Home tab, clipboard, format painter. And I'm just going to paint all these cells over here so that they should be number formatted with a comma and whatnot. All right, then we'll select these three. We're going to go to the Home tab, Alignment, increase the indenting. I'm going to go to this one, Home tab, Alignment, increase the indenting. And then we have year 3. So now we have the interest, year 3, colon, and once again, plus the loan, plus the rate, and then interest, year 3. And the loan still's the same, the 420, because we're not paying back any of the loan balance on the principal. The rate, we're going to say, what happens if it jumps all the way up to 16, which would be horrible. If that doesn't show up as a percent for you, Home tab, numbers, you want to percentify it, and then Home tab, font group, and underline it. Then we'll multiply this out. This is going to be equal to the 420 times the 16%. So there's the interest for year 3. Let's go ahead and indent these 3 cells. Home tab, alignment, increase the indenting. I'll take this one out one more time. Home tab, alignment, increase the indenting. This will be then the total. Well, let's just say this, let's make it equal to interest for the life of the loan. So it's the same as up top. Summing up the 3 years equals the sum of the 3 years. And then we'll underline here and underline. So we'd have to pay 33.6, and then it would jump up to 54.6, and then 67.2, and we'd have to pay back the original 420 that we borrowed in this case. So obviously this would be a worst case scenario, or a worser case scenario as the interest rates increase. And interest rates can be kind of volatile. In the U.S., they've been somewhat, they've been kind of artificially low for some time. They could, they could jump up depending on how long it is. So there is risk, of course, that the interest rates could jump if you have some flexibility in the loan. Obviously, if we were able to maintain the 8%, we would be better off. If it was, we would be paying the $100,800 of interest, and then here we'd be paying the $155,400. And we would be worse off. So whenever there's that uncertainty about something like the interest rate that could be jumping or be volatile in the future, we have to consider that risk in our decision-making process.